You know, a company's income statement isn't just some boring spreadsheet full of numbers. It's actually a story. Seriously, it's a narrative that tells you exactly how a business performed over a certain period, where its money came from, where it all went, and most importantly, what was left over. So let's dive in and figure out how to read that story.
We hear people say it all the time, right? Just give me the bottom line. Well, turns out that's not just a saying. It's a real place on a real document. And understanding the journey to get there, well, that reveals just about everything you need to know about a company's financial health.
The best way to think about it is like a report card for a business. It's not showing you what the company owns, but how it performed. Did it ace the semester with huge profits, or did its expenses get the better of it? This one statement holds all the answers.
But here's the thing. This isn't some creative writing exercise. The story has to follow a really strict set of rules. Financial regulators make companies present this info in a standardized way. Why? So that whether you're looking at a tech giant or a small local manufacturer, the story is always told in a clear and consistent way. It lets you make fair comparisons.
Okay, so before the story even begins, a company has to make a pretty big choice about how it's going to present everything. Is it going to be the short, simple summary, or a more detailed chapter-by-chapter epic? So what's the difference, really? Well, the one-step format is kind of like the summary on the back of a book. Here's all the money we made, minus all the money we spent. Boom, done. Simple, but you don't learn a lot. The two-step format, though, that's the full story. It gives us these awesome little subtotals along the way, like gross profit, that reveal how the company is actually making its money. And because it gives you so much more insight, all those juicy details, most companies you'll look at use that two-step format. It's the one that gives us those chapters in the story. So that's the one we're going to walk through together, piece by piece, from the very top line all the way to the bottom. All right, let's get into it. Our journey starts at the very beginning of the report. The first number you'll almost always see, which represents all the money coming in the door from what the company actually does.
And here it is, the famous top line, net sales. This is the grand total of all the revenue a company generated from selling its stuff, its products, its services, you name it. It's the starting block for absolutely everything else.
So we start with all that money from sales. But what's the first logical question you have to ask? Sure, but how much did it cost you to make the things you just sold, right? So we subtract that, the cost of sales, and that gets us to our first major insight, gross profit. And this number, gross profit, is so important. It tells you about the core profitability of what the company actually sells. Before we even think about marketing budgets or office rent, this number answers a fundamental question. Is the actual product we sell profitable on its own? This tells us. Okay, so we know the products themselves are making money. That's a great start. But a business is way more than just its products, right? You've got salaries, marketing campaigns, rent, the whole shebang. That's what we have to factor in next. These costs all get lumped into a big bucket called operating expenses. This includes a ton of stuff, but you'll almost always see a big line item called SG&A. That's selling, general, and administrative costs. It also covers things like money set aside for customers who might not pay their bills, the value your assets lose over time, and any costs from, say, reorganizing the company. So we take our gross profit from before, and from that, we subtract all the costs of just running the business. And this brings us to the second major plot point in our story, operating income. And this number really gets to the heart of the business model. It answers the big question. After paying for the products and all the day-to-day operations, is this core business actually making money? A healthy operating income is a fantastic sign of an efficient, well-run company. We're getting close. We figured out if the main business is profitable. But the story isn't quite over yet. Now we have to account for all the financial stuff that happens outside of the company's normal, day-to-day operations. This is where we adjust for things like income from investments or, on the flip side, the cost of borrowing money. These are definitely important, but they aren't directly related to the company's main mission of, selling widgets or providing a service.
So what kind of stuff are we talking about here? Well, a huge one is interest expense. That's the cost the company pays on its debt. It could also be gains or losses from investments, or even income the company earns from partial ownership in other businesses. Once we've added and subtracted all of those non-operating items, we land on another super important checkpoint. This is the total profit the company has made from its ongoing business, right before the tax man comes knocking. And here it is, the inevitable part of pretty much every financial story. From that pre-tax income, we subtract whatever the company owes in income taxes. It's usually a big number and a straightforward but absolutely crucial deduction. All right, almost there. Just one last bit of accounting cleanup. If a company sold off a whole chunk of its business, the profit or loss from that sale gets listed separately, down here. And that's really important because it makes sure the final number, the bottom line, isn't artificially inflated or deflated by a one-time event. It gives you a true picture of the ongoing business. So after that whole journey, starting with sales, subtracting the cost of goods, then subtracting all the operating costs, adjusting for other financial items, and finally paying taxes, we arrive at our destination.
Net income. This is it, the bottom line. This is the final grade on the report card. It tells you, after every single thing has been accounted for, what the company truly earned. The story has reached its end. So, why did we just go through all of that? Because knowing the structure of this story is like having a secret roadmap. It lets you see not just if a company made money, but more importantly, how it made that money. You can see if profits are coming from a really strong core business or if they're just from some one-time financial gain. You can spot if huge sales numbers are getting completely eaten up by out-of-control costs. You've learned the language. So the next time you look at an income statement, you won't just see numbers. You'll actually be able to read the story.
If you found this video helpful, give it a thumbs up. Your support helps us bring more valuable content to you. Don't forget to subscribe for the latest insights and research from GPS Research Publishers, Inc. Join our community and stay informed.